The ATO recently changed its treatment of income streams where the minimum pension requirement was not satisfied for a particular year. Mark Ellem from Accurium is with me today to discuss the implications of this amended approach. Hello, Mark. It's great to see you.
You too, Darren. Thank you very much for talking to me about this topic, one that is close to my heart on this one. So it was an interesting update that the ATO released.
Interesting update, and interestingly, it seems to have flown under the radar a little bit too. So it's great that we're talking about it right now. Anyway, so specifically, we're referring to the latest update of Tax Ruling TR 2013/5, and the situation where trustees may have not met the minimum pension payment for 1 year, but intend to resume satisfying this obligation in subsequent years. So let's start with just a bit of a refresher of what the situation was before this update was handed down.
Yeah, of course, Darren. Now, there wasn't, we all knew that this update was coming. The draft update had been issued back in November 2023, but in the draft, there wasn't too many big surprises. It was basically going to simply incorporate the 1 July 2017 changes that came into effect, introduction of the transfer balance cap regime, introduce some rules around successor fund transfers, which really didn't concern SMSFs. So there wasn't much change expected. So it was probably going to be one of those, when it came out, a bit of a ho-hum response. But when it did come out, noticeably towards the end of the financial year, where everyone else was focused on year-end financial matters, there's just one particular paragraph that was affected, which affected or concerned what you alluded to about where a fund fails to pay the minimum pension. Now, in the past where that happened, we all knew, okay, you fail to pay the minimum pension, two things happen. One, it ceases for tax purposes at the start of that financial year, which effectively means you don't get to claim exempt current pension income, ECPI, for that financial year in which the pension fails, right? One. The second one is that it ceases for transfer balance cap purposes at the end of the financial year on the 30th of June. And that gives rise to a transfer balance account debit equal to the value. So the main consequence, we don't get to claim ECPI. Okay, c'est la vie, we don't get to claim it. But then in the next year, we can say we can meet the requirements as long as, we can be a complying pension, meet the pension standards, as long as we satisfy the pension standards in the following year. So it was just, I think, a common approach to say, well, okay, as long as we pay the minimum pension in the next year, we get to claim ECPI, everything's okay. And from a transfer balance account perspective, we're going to restart it on 1 July, and using that, rule number one in accounting, the opening balance of one financial year equals the closing balance of the previous financial year. You've got your TBA credit on 1 July, that'll equal the TBA debit on the 30th of June. So they offset each other, no harm, no foul. Right? So I think that was a common approach.
Yeah, well, that makes a lot of sense. But what has changed now?
Well, what has changed was, if we look at, the original, it's one paragraph 20 of this ruling. We look at the original paragraph, and it's just like one line long, basically saying, look, if you fail to pay the minimum pension, but you can then meet the pension payment standards in the next year if you, again, meet those requirements. And all they did on the draft was delete the word again. That was it, one line long. But when the final version came out, we've gone from one line to about half a dozen lines, right? And the important bit in there is it refers to, well, look, even if you meet the pension payment requirements in the next year, so you pay the minimum pension, that doesn't mean that pension is a pension for the purposes of retirement phase, right? You have to actually cease the pension and restart it. So I refer to it and use the word that the member consciously has to cease the pension and restart it in order for that pension to now be considered a pension for retirement phase purposes and to claim ECPI. Now, when you think of it, you think, oh, well, why is that a biggie? Well, I think it's a biggie because for the member to consciously commute the pension, that can only be done in real time. Now, it's not a case of saying, oh, well, I'll do that effective as at a date in the past, right? 1 July, for example. Now, think about, when do you discover that the pension didn't failed the minimum pension payment standards in the year? So if we're looking at everyone starting up the 23-24 compliance season, preparing those financial statements for 23-24, you're preparing those financial statements now, or, you know, later in the year in November or January, February in 2025. And then as you're preparing them, your staff's preparing them, you discover, oh, we didn't pay the minimum pension, or the trustee didn't pay the minimum pension out. So in the past, we'd say, okay, we just failed to claim ECPI for the 23-24 year. But given the wording of the new paragraph 20 in the updated ruling, it's, my view is that it's saying, hang on, if you want to restart that pension, if you want to meet the pension standards, you do have to actually commute it, consciously commute it, or the member does, and restart it. Now, that can only happen from the date that they become aware that they failed the minimum pension. So if that's in November 2024, that's when they can commute it. Remember, commutation is about saying, I'm giving up my right to a future income payments for a lump sum. So if I'm commuting the whole pension, I'm doing that now. If that's November 2024, I'm doing it in November 2024, and I'm restarting it. Now, there's two outcomes from that. Firstly, our denial of claiming ECPI in relation to that failed pension is not necessarily isolated to the 23-24 year, the year we failed to pay the minimum pension. It's likely to say, well, we can't claim it up until we commute the pension, right? Because it can't go back in. The other consequence is, well, when we restart that new pension in, say, November 2024, that gives rise to a transfer balance account credit. Now, considering that's at a later date from when the transfer balance debit arises at 30 June, because we failed to pay the minimum pension, the difference between the debit and the credit, well, there is going to be a difference. There's likely to be a difference. They're not going to be the same as when the more common, well, the common approach, I believe, would have been to the pension stops on 30 June and restarts on 1 July. So that difference in the value of when we restart the pension after the member consciously commutes it and consciously restarts it, you know, that's going to have it, or potentially have, a transfer balance cap consequence. For example, it could lead to an excess.
So does that mean trustees in this situation will have to go through that whole valuation of assets process involved with any of the assets supporting what was previously an existing pension, but now has to be a restarted pension?
Yes, because if you look at the ATO's outline of when do you need to value assets, obviously we know we have to do that as part of the annual financial statements, but it also concerns when we are starting a pension. And that's what they've said here. We've got to cease, you know, for the example, commute the pension. So if we're commuting it, we're going to have to work out the value of the commutation. Now, when the member consciously commutes that pension, that's not going to give rise to a TBA debit, because at that point in time, it's no longer a retirement phase pension. It ceased at the previous 30 June. That's when the TBA debit arises. But now that the member says, I consciously commute it, I want to restart it, so it becomes a retirement phase pension again, we're going to have to go through the process of working out what's the value, what's the commencement value of this new retirement phase pension. So yeah, we're going to go through that process of valuing assets, which may be a straightforward process. It might be a little bit more involved depending on the type of assets the fund has.
Yeah, that sounds like administration will be a little bit more of a challenge if you do find yourself in this situation. Can you confirm that will be? And are there any other flow-on effects that trustees have to be aware of?
Well, yeah, there's going to be an admin issue there, and potentially admin cost associated with that. To work it out, new pension documents, documents to cease, documents to recommence. All right, so consider what the TBA effect of that credit is. What effect is it going to have on the member's personal transfer balance cap? Does it lead to an excess? You know, is that going to upset future plans? Thinking I had that much transfer balance cap space, now I don't. I only have that much. It might be more actually, because the value could have gone down. Right, so we're going to have to work out all those consequences. The other one interesting question out of that is, do we need a new statement of advice? The member's going to cease an interest in a super fund, a financial product, and commence a new pension, a financial product. You know, do they need to get an SOA, and what are potentially the costs associated with that? So I think, you know, normally the reason to not fail to pay the minimum pension is because you miss out on claiming ECPI. I just think this just adds to the reasons to make sure that in your practice, whether you're the advisor, whether you're the administrator, whether you're the accountant, whether you're the trustee, make sure you pay the minimum pension each year. You know, do that review in April and May of each year. I know we're past that now, but, you know, if you don't have that process in place, and I know a lot of firms do have that process in place, but make it clear to members, to trustees and to their members that they really need to ensure that they meet these payment requirements. Now, we talk about the minimum pension, you know, that's the main issue, but remember, it also applies if we exceed the maximum, if we break the pension standard. So it could be a tris, you know, and most people think, well, who cares about a tris, Mark, because we don't get to claim ECPI anyway, there's no transfer balance account issues. But the big thing about a tris is all the payments of the failed pension are now lump sums. A tris normally is commenced on preserved benefits. You've now breached the payment standards because you're now, all those pension payments are lump sums. So you breached the preservation rules. Right, so that can have tax implications as well. Or you could have one of the old, dare I mention it, Darren, an old legacy market link pension, which has a minimum, yes, which you have a minimum and a maximum. So, you know, if you fail to pay the minimum, but again, you have the same issue if you fail to pay a maximum. And thinking about that, you know, what are the consequences there? Because if it was a pre-1 July 2017 market link pension, which is a capped defined benefit income stream, and you stop it, you commute it, and you restart it as a new market link pension, that's not a capped defined benefit income stream, and they're both treated differently for transfer balance cap purposes. Like, there could be some dire consequences coming out of simply not ensuring you've paid the right amount.
Wow, you've highlighted that this is actually, even though it's a few lines on this tax ruling, very, very significant change. Thanks for the discussion, Mark.
My pleasure.
Mark will be exploring this subject in more detail at the Accurium SMSF Compliance Day 2024, commencing in Brisbane on the 22nd of August and concluding in Melbourne on the 29th of August. There is also an online component that will be presented over the 3rd and the 4th of September. To find out more about the day and register, please reference the details you can see on your screen now. Well, thanks again, Mark, for that discussion, and I'm looking forward to finding out more about this topic at the event.
Thank you, Darren. Yes, small change to a ruling, but could have potential large consequences. So yes, that plus a whole heap of other in a full agenda for the day. Looking forward to it.